Hey everyone, welcome back to Corporate Decoder, the place where we decode the stories hidden within corporate filings. And boy do we have a story about World Scan Project Inc. Today it's a wild ride from crypto miners to drones and a whole lot of financial reshuffling. Alright, let's dive into what this company World Scan Project Inc. has been up to. This isn't just a regular update, it's an amendment, meaning they're going back and fixing some numbers from a previous report. The big reason, they're changing how they report their revenue, shifting from a net basis to a gross basis, all thanks to a chat with their auditor. This is a pretty big deal because it can make revenue look a lot different. Now, they are indeed filing all their interactive data on time, which is a sign they're keeping up with the rules. Let's get straight to the money. The company has about 11.5 million shares of common stock and 10 million shares of preferred stock out there. First up, the balance sheet, which is like a snapshot of what the company owns and owes. Look at inventories. As of July 31, 2024, they have over $15 million in inventory, a huge jump from about $358,000 the previous October. This massive increase in inventory suggests they are expecting to sell a lot more, or perhaps they've bought a lot of raw materials. Advance received is also up significantly, from around $33 million to nearly $6.6 million. This usually means customers are paying up front, which is good for cash flow. All these changes mean their total current assets, what they can easily turn into cash, have more than doubled from about $11.3 million to over $23 million. On the other side, their liabilities, accounts payable to related parties, are pretty small, just around $18,000. But look at accrued expenses and other payables. They've more than tripled from about $983,000 to almost $3 million. This means they owe more money for things like services already received but not yet paid for. Overall liabilities have gone from about $5.3 million to over $10 million. Now for the shareholders' equity. Their additional paid-in capital has exploded from just over $2 million to over $10 million. This typically means they sold a lot of stock. But here's a big one, accumulated earnings. These have gone down from about $9.1 million to $8 million. This is because they have been losing money overall, offsetting any past profits. So their total shareholders' equity has jumped from about $8.7 million to almost $16.4 million. While equity is up, it's important to remember that a chunk of this is from selling more stock, not necessarily from the business itself becoming more profitable. Let's move over to the income statement where we see how much money they made and spent. In the 3 months ending July 31, 2024, they reported revenues of about $2.1 million. This is a huge leap from the previous year's quarter, where they had only $86,000. However, if you look at the revenues net line in the prior year, it was almost $5 million. When you combine them, the total revenue for the prior year's quarter was over $5 million, while the current year's total is just over $2.1 million. So even though the new reporting method makes their revenue look different, the actual top line number is significantly lower than the prior year quarter. Their cost of revenues has gone from a mere $25,000 to almost $1.7 million. This makes sense if they're selling more products and incurring the costs associated with them. This has resulted in a much smaller gross profit this year, about $400,000 compared to over $5 million in the prior year. Now let's talk about expenses. Research and development expenses are a big part of this story. In the 3 months ending July 31, 2024, they spent about $318,000 on R&D, but in the same period in 23, they spent a massive $18.4 million on R&D. But in the same period in 23, they spent a massive $18.4 million on R&D. This huge drop in R&D spending is a critical point. It suggests they might have completed a major development phase or have significantly cut back on innovation for this particular reporting period. General and administrative expenses, which cover things like management salaries and office costs, are also down from about $3.6 million to $1.1 million for the quarter. The bottom line is a net loss. For the 3 months ending July 31 to 2024, they lost about $860,000. This is actually better than the $10.9 million loss in the same period last year. However, the dramatic reduction in R&D and G&A spending heavily influenced this improvement. What's interesting is the foreign currency translation adjustment. It swings wildly from a negative $460,000 last year to a positive 984 edge in Japan, and the exchange rate between the Japanese yen and the US dollar fluctuates, impacting the reported value of their assets and liabilities. And the earnings per share, well, it remains negative, showing they are still losing money on a per share basis. This next table shows how the shareholders' equity changed over time. Notice the common shares sold lines in the period leading up to April 2024, and then again up to July 2024, they sold a significant amount of common stock. This is how they raised a lot of money and increased their additional paid-in capital. For instance, between February and April 2024, they sold shares that brought in about $5.8 million. Then in the following quarter, they sold more shares, bringing in another $2.7 million. This confirms that the increase in equity is largely driven by issuing new shares, not by the company becoming profitable. Let's look at cash flow, which is the lifeblood of any company. For the 9 months ending July 31, 2024, they used over $11.4 million in operating activities. This is a massive outflow of cash. This is mainly because they bought a huge amount of inventory, over $14 million. This contrasts sharply with the previous year when their operating activities used about $5.8 million. They also spent a substantial $571,000 on intangible assets like software or patents. On the financing side, though, they brought in over $8.5 million from selling shares for the 9 months ending July 31, 2024. This inflow helped offset some of the cash burn from operations. As a result, their total cash balance decreased by nearly $4.6 million during this period. The company itself was incorporated in Delaware back in 2019. Their main business is developing and manufacturing drones and dabbling in industrial drones and dabbling in industrial automation equipment. This section explains the big reshuffling of their revenue reporting. They initially recorded revenue from selling crypto miners as an agent, meaning they took a cut. Then they changed it to reporting it as product sales with their own cost of goods sold. Now, with their current auditor's input, they've decided that starting from their 2024 fiscal year, they should be reporting it solely as product sales with associated costs. This change is what led to them filing this amended report. They've restated their past financial statements to reflect this new way of thinking about revenue, and it makes a pretty big difference. For example, in their restated balance sheet for April 30, 2024 fiscal year, they should be reporting it solely as product sales with their own cost of goods sold. Now, with their current auditor's input, they've botheration, and looking at the revenue summary under the restated numbers for the 9 months ending July 31, 2024. Revenues are about $12.9 million. But in the previously reported numbers for the same period in 2023, it was over $28 million. This massive drop is directly linked to how they are now accounting for crypto miner sales, which previously made up a huge chunk of their revenue. They're using generally accepted accounting principles in the US and have a Japanese subsidiary. They're also capitalizing all leased assets, meaning they are putting leases on their balance sheet. When they translate their Japanese yen results into US dollars, they use current exchange rates for assets and liabilities and average rates for income and expenses. Any differences from these translations are recorded in a separate part of their equity. They're expensing research and development costs as they happen, which is pretty standard. This is where things get really interesting. For the 9 months ending July 31, 2024, R&D expenses were only $630,000. Compare that to the same period in 2023, where they spent almost $18.5 million on R&D. They specifically mentioned spending money on a cooling system for data centers and technology for NFTs. The huge drop in R&D spending from 2023 to 2024 really stands out. It could mean they've scaled back their innovation efforts or perhaps have shifted focus for the current period. They've got some tax credits, about $294,000 for 2024, which helps offset their losses. In Japan, where they do most of their business, the tax rates vary quite a bit depending on profit levels. The company has preferred stock with no voting rights, but it can be converted into common stock. They've also seen a significant increase in common stock outstanding due to their S1 offering. Over 743,000 shares were sold in the period ending July 2024, bringing in over $8.5 million. This all ties back to that rapid increase in additional paid-in capital we saw earlier. The report mentions the company's financial statements are prepared assuming it can continue as a going concern. This means they believe they can keep operating and pay their debts. They point to positive trends like increased working capital and improved net income compared to last year, and believe they have resolved earlier doubts about their ability to continue operating. Now, this is a really important part. They've identified material weaknesses in their internal controls. This means their financial reporting might have some serious issues. The main problems are domination of management by one person without enough checks and balances, not enough independent directors on the board for proper oversight, poor segregation of duties and no audit committee. These are pretty significant concerns for anyone looking at the company's reliability. They've issued a lot of stock since they started, mostly for services or through private placements. The funds from these registered sales are planned for R&D, marketing and working capital. So what's my take on World Scam Project Inc? The company is clearly going through a major transformation, evidenced by the restatement of their financial reporting and the drastic cut in R&D spending. While the increase in equity from stock sales and the reduction in net loss are on paper improvements, they are heavily influenced by changes in accounting and reduced investment in future growth. With significant inventory build-up and a large cash contribution coming from issuing more stock, it seems they are trying to fund operations and future plans through financing rather than strong operational profits. The material weaknesses in internal controls are a big red flag suggesting potential issues with financial transparency and governance. The company's direction seems to be shifting, possibly away from heavy R&D, towards operationalizing existing products or perhaps a different business strategy altogether given the reduced spend. A key opportunity lies in how effectively they can manage this inventory and turn it into sales. The major risks involve their ability to generate sustainable revenue without relying heavily on stock sales and addressing those internal control weaknesses which could impact investor confidence. Ultimately, World Scam Project Inc. is in a critical phase where they need to prove their business model can generate actual profits and operate with sound internal controls. Alright, that's our breakdown of World Scam Project's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. We talk all things corporate finance there. Thanks for watching. See you next time.